This is Nightly Business Report with Sue Herrera and Bill Griffin.
Buckle up. The slump in tech stocks accelerates. Now investors want to know if the market can move higher without them. Protect your portfolio. Simple ways you can smooth out this rocky market and keep your money working for you. Trading places. China and Japan tighten their trade ties as both face tough negotiations with the U.S. Those stories and more tonight on Nightly Business Report for Friday, October 26th. Good evening, everyone, and welcome. Bill Griffith is off tonight. Well, the week on Wall Street ended the same way it began, with wild swings and intense bouts of volatility. It was driven by earnings, anxiety over global growth, and concerns of higher interest rates. In fact, by some estimates, the global sell-off has erased $5 trillion from stock and bond markets so far in October. Today, all 11 sectors of the S&P fell. The S&P 500 briefly fell into correction territory, meaning it is down more than 10% or more from its most recent high. And within the S&P 500, more than 75% of its components are in correction. The Dow Jones Industrial Average fell 296 points to 24,688. The Nasdaq was off 151, and the S&P 500 was down 46. The Nasdaq is down for 4 straight weeks. The Dow and the S&P are down for the 4th time in 5 weeks. Bob Bassani has more on all of the stock market angst.
It was another volatile day with a morning sell-off, a big late morning rally, and a drift lower into the close. Stocks are resetting 2019 earnings and revenue expectations. That's what's going on, particularly after some high-profile misses on revenue from Amazon and Alphabet today. The forward PE multiple on the S&P 500, it's below 15. It was 16.5 a month ago. A lower multiple means market participants think expected earnings growth of 10% is in some doubt. Now, we've got good news here. There's moderate inflation, declining unemployment. The market, however, has come to believe that a slowing China, tariffs, maybe an overly aggressive Fed, collectively constitute at least a modest threat to top and bottom line growth in 2019. Political issues in Washington may also be playing into the volatility stew. President Trump's unusually aggressive attacks on the Fed chairman is generating a lot of debate, with some arguing that the Fed cannot now back down on a December rate hike without looking weak. If 2019 earnings were only an issue with high multiple tech and internet stocks, so the market would not be that worried. These internet names, the Amazons and Facebooks, the Alphabets, they tend to be classic momentum names that would be sold immediately with even the hint of a slowdown. But the sell-off is broader than that. Semiconductors, for example, are down on what appears to be a cyclical downturn in demand. That's taking hardware and software stocks down with it. That's a lot more serious. Finally, the elections are another whole wild card for the markets in the next week. The assumption is that even if the Democrats retake the House, the corporate tax cuts will not be imperiled. But the likely prospect of endless political fights after that may only serve to undermine confidence. For Nightly Business Report, I'm Bob Bassani at the New York Stock Exchange.
Bob just mentioned tech and internet stocks, and as you know, that group helped lead the market higher most of the year. But they've taken a big tumble in October. Netflix, Amazon, Facebook, and Google are all down sharply. And now it seems that the higher you climb, the faster you fall. Dominic Chu has more on tech's sharp and steep decline.
One of the most concerning aspects of the recent downtrend is the underperformance of certain key technology and communication services stocks, namely the FANGs, that is to say, Facebook, Amazon, Netflix, and Google parent company Alphabet. As the major U.S. indices have their worst October since 2008, these are among the stocks moving markets the most. Each of them is underperforming the broader S&P 500 so far this month. They also happen to be some of the most valuable companies in the market, which means they have a lot more influence on market value-weighted indexes like the S&P 500 and NASDAQ Composite. Over the course of the last few years, these stocks have led the market higher, pushing not just their values to high levels, but the valuations as well. The overall S&P 500 trades at 19 times earnings, meaning an investor pays $19 in stock price for every $1 of earnings it generates. In contrast, Alphabet currently trades at around 46 times earnings. Netflix trades at 109 times earnings, and Amazon trades at a whopping 130 times earnings. Facebook had traded at a bigger premium to the market before investors sold shares off in the past few months as the company was embroiled in a data privacy scandal. It now trades at just 22 times earnings. The issue is whether or not these valuations for many of these companies is justified given the outlook for profits and the overall economy. And the current selling pressure in the markets is the manifestation of this revaluation process taking place. For Nightly Business Report, I'm Dominic Chu.
So, can the market turn around and turn higher without the help of those big tech stocks? Sarah Malik is head of the Global Equities Division at Nuveen, the investment management arm of TIAA. Welcome, Sarah. Nice to have you here.
Hi, thanks for having me.
I guess that is the question. Can the market turn higher and continue to move higher without the participation of some of those tech stocks?
We think that it can because some of these technology stocks were actually priced for perfection. And when they report earnings that aren't perfect, you're going to see these kinds of declines, especially when investors are nervous about other items such as trade, interest rates, and inflation. But if you take a step back, economic data remains strong. Manufacturing numbers look good, the employment numbers look good, and if you look at valuations, the market is starting to look pretty compelling. On next year's earnings for the S&P 500, the market is now trading at under 15 times earnings. So what we think will work from here is actually what we call quality growth stocks. These are companies that are growing sustainably, but they have reasonable valuations in areas such as healthcare, consumer staples, and even in some really beaten down areas that have really gotten hit this month, like financials, where you have strong balance sheets and cash that's being returned to shareholders.
So I'm hearing from you that you think the bull market is still intact, although maybe a little wobbly near term.
Yeah, I mean, investors, it is intact, but investors have had a lot of reasons to be pessimistic this month. We're worried about trade. We saw third quarter earnings come in, and they were kind of sloppy. And what it's making people wonder is this cycle really going to last as long as we hoped? Can earnings continue to grow through 2019? We think earnings can grow at double-digit rates, and this will be supported by this strong economic data that we're seeing that won't change on a dime. It remains very strong, and that really, plus earnings growth, is going to be what drives the market higher from here.
So I assume that you're one who expects, as many do, the volatility to continue. And in addition to those growth stocks, if we continue to see further weakness in tech, if you're a long-term investor, would you add to positions in that area?
So we would be looking for those technologies that fit that quality growth at reasonable valuations type of mantra. So look for those companies that have sustainable growth rates, strong free cash flows, structurally growing businesses, but make sure the valuations look promising. And if you can find that, you should be adding to any sector, including technology. We just wouldn't overpay. When you're late in the cycle like we are now, you don't want to overpay for companies. All
right, on that note, Sarah, thank you. Sarah Malik with Nuveen. And a bit later in our program, our market monitor will explain why big tech companies are on his buy list. Now to the economy that grew at a faster than expected pace last quarter. The Commerce Department said GDP expanded by 3.5% during the third quarter. That was less than the previous period, but still stronger than what economists were forecasting. Strong consumer spending and a rise in business inventories helped the results. Well, before the release of that economic growth report, the head of the Cleveland Fed said that the central bank's economic forecast suggests gradual interest rate hikes are appropriate.
Financial conditions are still accommodative. I think that the economy is still growing above trend. I think the unemployment rate is at its lowest level since the late 60s, and I think inflation's at our target. So that's a strong outlook, right, and suggests that we probably need to be gradually thinking more about taking back some of the accommodation.
Mester is a voting member this year on the Fed's policymaking committee and said the wild swings in the stock market are a risk to the outlook, but they are not impacting her view at this point. Consumer sentiment remains near historic highs despite a slight pullback in October. A survey from the University of Michigan says stock price declines, rising inflation, and interest rates have not, so far, undermine consumer confidence. Those who answered the survey remain optimistic, in particular about job growth. It is time to take a look at some of today's upgrades and downgrades. Twitter was upgraded to outperform from perform at Oppenheimer. The analyst says the stock is reasonably valued and has less execution risk than other social media companies. The price target is $37. The stock rose more than 1.5% to $32.36. Snap, the parent company of Snapchat, was downgraded to underweight from neutral at JP Morgan. The analyst cites the decline in daily active users. The price target is $6. The stock fell 10% to $6.28. Gilead's rating was cut to neutral from overweight at Piper Jaffray. The analyst cites the company's outlook for revenue growth. The price target is $75. The stock was up about 1.5% to $69.74. Still ahead, getting to work. Manufacturing jobs are being created, but not necessarily by American companies. The FBI is reportedly intensifying its criminal investigation into whether Tesla misstated Model 3 production figures. The Wall Street Journal reports that the electric automaker is facing a deepening criminal probe about those projections. But Tesla says it has not received a subpoena or a request for documents in months. The company is cooperating with a voluntary request for documents it received from the DOJ in September. The Trump administration, as you probably know, has made a push to bring more manufacturing jobs back to the U.S. by the way of tariffs and trade wars. But as Elon Mui reports from Gibsonton, Florida, it is actually investments from foreign companies that are generating a lot of the new job growth.
This brand new factory outside of Tampa, Florida, makes parts for gas turbines. It officially opened today, a $140 million facility that will employ 350 workers, exactly the kind of manufacturing that the Trump administration wants to bring back to America. The only catch? The company is Siemens, and its headquarters are in Germany.
We're a global company, so at Siemens we do business in 190 countries around the world. But our customers, it's important for our customers to have that we have a local presence.
Foreign firms are some of the biggest investors in American manufacturing, piling an estimated $1.6 trillion into the sector. And in recent years, they've generated more than half of new manufacturing jobs.
The pay was very competitive. The vacation was great. Everyone seems to be really flexible with your work-life balance here. So that was what initially attracted me.
But now Siemens and other multinationals are getting squeezed as tariffs drive up costs.
We're seeing that show up in our business really in the pricing that we have, both from our third-party suppliers and where we buy our raw materials and our supply chain. But what we're doing to combat that is facilities like this, where we're investing in technology and innovation that helps us bring our costs down. It helps us make our business more robust.
That means shortening the supply chain. Many of the parts made here will be shipped to Siemens' factory in Charlotte, North Carolina.
It's not so much to me protectionist versus non-protectionist. It's, in our view in Siemens, it's the right thing to do as we create economic prosperity around the world, being able to give back to the local communities.
The U.S. is Siemens' biggest market. The company's fortunes tied to the American economy. For Nightly Business Report, I'm Elon Mui, outside of Tampa, Florida.
The ongoing trade war with Washington is creating an unlikely alliance between China and Japan. A nation the world's second largest economy has often been at odds with. Eunice Yoon explains from Beijing.
Japanese Prime Minister Shinzo Abe has declared that his country's relations with China are at an historic turning point. Abe is in Beijing for a 3-day trip, a first for a Japanese prime minister since 2011. He traveled here with a 500-person business delegation and met with both the Chinese premier and the president. The two sides signed multiple agreements to cooperate on infrastructure projects in third countries and to expand a currency swap line to $30 billion to help safeguard against a financial crisis. Abe's visit is a big break from the past. The two countries have a lot of historical baggage, and relations turned sour in 2012 over a territorial dispute in the East China Sea. Prime Minister Abe has come to China at a time when Beijing is in a trade war with Washington. The Chinese have been trying to paint the U.S. as the bad guy and get more countries on their side. Japan, a traditional U.S. ally, has been criticized by the White House, but Abe has been very wary of China. He's been a big proponent of the regional trade pact once backed by the U.S., the TPP. On this trip, Abe refrained from making any pro-globalization statements or other comments that could have been perceived as anti-U.S., likely to the disappointment of Beijing. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Colgate-Palmolive warns of weakness ahead, and that's where we begin tonight's market focus. The consumer products company expects its emerging markets business to remain challenged. In the most recent quarter, Colgate-Palmolive reported weaker than expected revenue and said it is facing higher costs. Colgate shares fell more than 6% to $59.58. Charter Communications added more internet subscribers than Wall Street had been expecting in the third quarter. That made up for a drop in video subscriptions. But it was not enough to offset weaker than expected revenue for the quarter, and that pressured the stock, which fell more than 6% to $295.01. Phillips 66 benefited from higher refining margins and topped earnings estimates. The company's pipeline business also turned in a strong quarter, with earnings at that unit more than doubling. Shares rose nearly 1% to $99.45. Autoliv, the world's largest maker of airbags and seatbelts, cut its full-year sales growth forecast due to lower demand in China and the impact of tougher emissions tests in Europe. The company said it's managing those changes, and it cited growth in its North American operations. The shares rose 2% to $81.77. Biopharmaceutical company Ultragenyx reported disappointing results for its experimental treatment targeting a rare genetic metabolic disorder. The company said it would discontinue testing the drug for this specific cause, but it intends to continue developing it for another disease. Nonetheless, the shares plunged 18% to $48.62. And now to our weekly market monitor, who is sticking with some of the biggest names in tech despite this week's sell-off. He's betting on the cloud. He is Mark Tepper, President and CEO of Strategic Wealth Partners. Welcome. It's nice to have you here.
Thanks for having me.
So you're a brave guy. You're stepping into some of the names that have gotten hit quite hard this week. So let's talk about why. You're picking Amazon, which had its worst day since 2014 today.
Right.
But you're looking longer term. Why do you like it?
Perfect timing, right? I mean, so yeah, Amazon, they're just an absolute disruptor. I mean, they enter an industry and another industry and another industry, and they own every industry that they enter. They have an addictive product with Amazon Prime. Literally anything I want to buy, I can pull out my iPhone and have it delivered to my doorstep within 2 days. So it's a great business model, and we're really bullish on the cloud right now. And when you look at Amazon's cloud and advertising, I mean, those are really their high margin businesses, and those two specific businesses are just growing like crazy, and margins are expanding like crazy. So we really think that if they continue to focus on those areas, in addition to e-commerce, we think that they can really just eventually move to an even higher level, which is, that'd be tough for a company like Amazon.
Right. Google is your next pick. It also had a rough week, certainly, but it has had a lot of success in the area that you're focusing on.
Yeah, so they're great when it comes to the cloud, but probably the most important thing about Google is they are just the king of online advertising. I mean, you look at Facebook as an example. So Facebook was really trying to compete with the ads. They still are, but their platform wasn't as good as Google's a year ago. And now what you see happening with Facebook is they no longer give their advertisers the ability to use demographics to really zero in on the people that they're trying to advertise to. So it makes Facebook's advertising even less effective. So what we think is going to happen is we think that a lot of those Facebook advertising dollars are going to move over towards Google.
And Microsoft rounds out the three that you're looking at. Why do you like it?
Microsoft is good in both the cloud and gaming, and we are bullish on both of them. So I've already talked a little bit about the cloud. We see that over the course of the next 2 to 3 years, we think cloud usage is going to double. Microsoft is in a unique position because they offer a hybrid solution that's really good for those bigger companies who've invested internally to grow their IT, because they might not want to switch abruptly over to the cloud. So they're doing really well there. And then on the gaming side of things, gaming is it's a high growth industry. The esports in particular have seen 40% viewership growth over the course of the last year. Major league sports in general have seen declining viewers. So, we think with them being in both the cloud and gaming, the potential is huge for them.
On that note, Mark, thank you. Mark Tepper with Strategic Wealth Partners. To read more about his picks, head to our website, nbr.com. Coming up, a strategy for long-term investors as market volatility picks up. Here's a look at what to watch for next week. Key earnings reports will be released from Facebook, Apple, Coke, Pfizer, and General Electric. We'll see if consumers are still shelling out record amounts for cars with the release of October auto sales. And the week ends with the government's monthly employment report. And that's what to watch for next week. With stocks down today and volatile for the week, we decided to see how all of the ups and downs are affecting individual investors.
I have some money in mutual funds, and I'm afraid it's going down. And it's sort of, it's about money that's been in savings, and I'm afraid I'll be losing money.
As soon as the market gets volatile, everybody gets scared and it creates more volatility.
It did drop not too long ago, from what I understand, and it jumped back up. So if we keep going where we're going now, I don't think we'll have that too much of a problem in the near future.
And institutions get nervous. People get nervous, and then it bounces back.
Markets go up and down. I got a long view of it all.
So what should the individual investor make of the recent market rout? We're joined tonight by J.J. Kinahan. He is the chief strategist at TD Ameritrade. Always great to have you with us, J.J.
Thanks for having me.
Those sentiments that we heard from the individual investor, is that what you're hearing from your investors as well?
We are, and I particularly like the last gentleman on there who he knew what his time frame was. And I think for the folks watching your show tonight, that's actually the key. If you're someone who happens to be more of a trader and you're in and out a lot, great, good for you. Volatility's high, you're happy. But for most of your audience, they are taking a longer view. So they have to keep that in mind. And they have to say, okay, I'm in this stock for 3 months, 6 months, a couple of years, whatever the time frame may be. Knowing yourself and knowing your time frame when you get into the stock will make a big difference in your investment success, because otherwise, weeks like this, you're going to drive yourself crazy. There's been a lot of movement. That said, Sue, outside the knowing your time frame, there is something going on right now that's really important, and that is there's a repricing of what these stocks are worth. Got to remember, and I think sometimes people forget, that the stock market's a forward-looking device. What they're saying is in 6 months, we don't know if we valued the stocks right now for that time frame. There's a lot of macroeconomic things going on, the election, possible higher tariffs, et cetera. So it may mean that we price stocks too high. Not the end of the world. It's just a shifting of the ground underneath us a little bit, and it usually takes a few weeks, and in this case, it may take a month or so for things to settle back down and people to be comfortable with where valuations
And you make the point in one of your pieces of literature that you put out to clients and traders and investors today. You have to take that broader outlook and couple that with what CEOs are saying about their own view for their company and factor all of that in.
And absolutely. You see that with Amazon and Google last night. Their guidance was lower. Their numbers really weren't very bad. They were pretty good, actually. And in this earnings season that we're in right now, it's all about what the CEOs see for the future. And if you think the last 2 earnings seasons, the CEOs talked about great growth, not only in the U.S., but worldwide. in this earnings season, many CEOs are saying we can still grow, maybe not at the pace we thought we could 3 or 6 months ago. It's not the worst thing in the world. And, you know, if people keep the longer term, again, perspective in mind where we've come from, it's okay. Take a breath. And it's all about buying companies that are good companies. That's not to say that because companies got hammered on earnings, which, you know, Amazon and Google did, they're not bad companies and
Right.
they still make a ton of money. But if you still believe in them long term, it's you know, a way that you can buy them a little bit lower right now.
And very quickly, JJ, do you believe we still have more room in the bull market for those who might want to use this weakness to their long-term advantage?
I do, Sue, but I will say this, we're not going to get there smoothly. It's going to be a very volatile period for the next few weeks. So if you go in and you buy now, you may want to, if you have 200 shares to buy, maybe you buy 100 now because you might be able to get 100 cheaper in a week or so.
Very good advice, as always, JJ. Nice to have you with us.
Always a pleasure, Sue. Thank you.
JJ Kinahan with TD Ameritrade. So on that note, let's take a look at the final numbers from the day on Wall Street. The Dow fell 296 points. The Nasdaq was off 151, and the S&P 500 was down 46. The Nasdaq is now down for 4 straight weeks. The Dow and the S&P are down for the 4th time in 5 weeks. And if these markets weren't this week enough to scare you, maybe this will. Halloween candy is getting more expensive. According to IHS Markit, candy prices are up 0.5% this year after 2 years of price drops. Total spending on all of that sweet stuff is expected to total $2.5 billion, the most ever, and that is roughly $20 per household. And on that note, that does it for us tonight. I'm Sue Herrera. Thanks for joining us. Have a great weekend. We'll see you on Monday.